Hello, hello, hello. What's going on, everybody? Welcome to a Capital Hungry Market Update and Trade Ideas webinar. It is currently end of the business month of February, Tuesday, February 28th, roughly 5:10 p.m. Eastern, just winding down the North American trading session. Hopefully you guys can hear me loud and clear in the YouTube land, and you just have a blank screen with gold here before we jump into the content for today. Okay, so it sounds like everybody can hear me, no technical issues, so let's just jump right into the content and the meat and potatoes here, shall we? Now, when we're looking at key fundamental points that are still active, dollar domination is still holding weight. As we have the markets pricing in further of tightening of financial conditions by the Fed, this is leading to more demand in the dollar and less demand in some of these risk asset classes such as US equities and even gold being more bearish. The reason for this is the markets are pricing in the Feds will be more aggressive with combating inflation because we have had healthy macroeconomic data from very optimistic labor market reporting, stronger PMI data, healthy retail sales, and of course because we've had increasing inflation figures, higher CPI, higher PCE pricing, and so forth. This is bringing in more demand into the dollar and leading to an outflow in US stock markets, gold, and other asset classes such as oil. So I still want to continue to play the dollar domination narrative and stick to primarily looking for those dollar buyer bias. We just have to keep in mind that we're just ending the business month of February and setting up the new business month of course, March. So we will potentially see some price setups. For those of you who may have noticed, even on GJ, we saw an aggressive end of month rebalance of flows as we printed new highs, but also saw a very aggressive pullback phase. In my opinion, that pullback phase is just to retest better buy zones, as fundamentally GJ is still very bullish, with the Japanese yen being bearish on dovish comments by Bank of Japan Governor nominee Ueda and Bank of Japan Governor deputies Uchida and Hinona, if I'm pronouncing that guy's last name correctly. So the reason why Japanese yen has been more bearish over the last week, and you've seen pairs like GJ, EJ, AUD, GPY trending more bullish, is primarily due to that fundamental catalyst of the Bank of Japan sticking to their loose monetary policy and keeping interest rates in the negative and continuing to look to accelerate inflation. Also this week, we had the Brexit deal completed and had some more optimism brought into the British pound short term. One thing we have to look out for, which is already highlighted, is of course the end of month rebalance of flow moves and how we're just starting out the new business month. But the main fundamental bias I still want to play is dollar strength, with the markets pricing in more tightening of financial conditions due to accelerating inflation and elevated inflation. Japanese yen bears, with the market still pricing in a dovish Bank of Japan, as Bank of Japan's governor nominee Ueda continues to cement the same monetary policy as Kuroda. And I still want to primarily play the same market structure that we've been playing from last week's market update continued. So if you want some even more information, check out last week's market update, as we're going to be looking for continuations of those trade ideas, just looking at key price points of interest that we're sitting at now. And we're just going to do a quick higher time frame to intraday time frame analysis as we go through the pairs. So market sentiment wise, dollar still remains bullish, Japanese yen bearish, and US equities bearish for those reasons stated. And we still want to look to extend that, just give or take some pullbacks and price setups for this new business month of March. When we're looking at market sentiment, you can see, even though we had a little bit of worse economic data today on the US side in the morning, we're still maintaining intraday bullish market structure. We're still having buyers print these consecutive higher highs, and we're still having more demand in the dollar as the markets price in more hawkish actions to come by the Federal Reserve due to elevated inflation and other economic data still being relatively robust in the example of labor market reporting. When we do a quick higher time frame scan and you look at the monthly time frame, you can see we have very nice bullish higher time frame price action. This pullback that we saw for the start of this new year was really just price setups, false delusional Fed pivot prayers that really just led to a pullback to retest key historical points in demand zone around 102. So all we really did was have this large impulsive rally. And then at the end of 2022 into 2023, a 50% correction phase here, which really just came to retest a very key historical price point of interest you could see across the board. And then we started to have fundamental catalysts come into play, which was bringing more demand into the US dollar, which was extremely optimistic NFP, stronger retail sales and consumer confidence reporting, higher CPI figures, and higher PCE data showing that the Fed's fight on inflation is nowhere near complete. More action needs to be taken, and no matter when we're looking at the dollar, even if we get a bit of a pullback for this new monthly candle to set up, it's still looking pretty bullish to start chugging back into these higher time frame highs, back into the 108s and 110s. Inflation is still quite elevated in the US and is looking to accelerate, and other economic data from the labor market side is still robust enough, showing that the economy can handle further tightening of financial conditions by the Fed, and we're also seeing that correlated outflow out of equities. On an intraday perspective here, when you're looking at the dollar, as long as we're holding above this price sensitivity area, roughly around 103.5, even if we do get some deeper pullbacks for the new monthly period, or if we start trending above these intraday highs, roughly around 105.5, dollar is still technically and fundamentally bullish. Meaning, in terms of correlation to our dollar pairs, I still want to look for pullback GBPUSD sells, EURUSD sells, UCAD buys, and then obviously less demand in US equities and potential US equity bears, Dow Jones, NASDAQ, S&P, whatever it may be. So we still want to stick to that higher time frame dollar bullish bias. Just had a pullback for the start of the new year and some corrective structure in relation to the overall huge dollar domination rally we saw through 2022. We came to retest very key demand zones and have had fundamental catalysts stacking up for more demand in the dollar, as well as some nice technical price action and market structure formation as well. When we're looking at market sentiment in the Japanese yen individually, you can see a very similar type of story. All we really had take place on the Japanese yen at the end of 2022 and into 2023 was a short-term pullback phase to retest previous key higher time frame lows, still not fully correct the overall bearish run in price here, which has primarily been influenced by the cartel of the currency for Japan, Bank of Japan, the central bank, keeping interest rates in the negative, monetary policy very loose, and financial conditions easy to stimulate their economy, increase wage growth, accelerate inflation, as Japan is dealing with the opposite issue of the other major countries and is trying to increase inflation in their country. So all we saw at the end of 2022 was a short-term pullback phase that came to retest a very key sell-side liquidity zone and previous higher time frame lows, still maintaining overall higher time frame bearish structure. And the fundamental reasons why we turned bearish from here were, number one, Bank of Japan at their last rate decision keeping everything status quo, and Kuroda still keeping the monetary policy loose. And then the previous weeks, the new Bank of Japan governor nominee Ueda also keeping monetary policy loose and continuing to follow suit with Kuroda. So on a higher time frame perspective, as long as yen is trading below 76.5, 77, it's very bearish. And on the intraday when we're coming here, you can see in relation to the overall bearish market structure, we just had a pullback to this key sell side liquidity zone. Very nice double top thanks to Bank of Japan, Kuroda keeping everything status quo, and very nice intraday bearish market structure forming thanks to Bank of Japan's new governor nominee Ueda. Make sure you guys check out Capital Hungry's Twitter, Telegram, and Instagram, because outside of these webinars, I always post little tweets or chart updates and predictions of what I see to come with fundamental information, whether it's pre-planned economic data, central banking, and so forth. And I don't want to sound cocky or toot my own horn, but I've been pretty on the money for a long period of time now. I've been pretty accurate. Obviously, do your own due diligence, do your own research, and follow your trading plan and risk management plan, because eventually one day I'll be brutally wrong. But so far, I've been brutally correct. So make sure you check out the other capital hungry platforms, because the Bank of Japan Kuroda being dovish was called ahead of time for free in market update webinars, as well as on Twitter and on Telegram. And even last week's Bank of Japan representative being dovish and keeping yen bearish was also called for free. Also, the predictions of higher CPI figures come 2023 and dollar domination coming back into the scene, that was also given for free. To be playing dollar buys since literally this entire month, gold bears, stock market bears, and so forth. So make sure you don't miss out that information. But anyways, on the intraday here, even if Japanese yen gives us some minor pullbacks to 74.5 or 75, or starts breaking these current lows, we're still looking to play Japanese yen bears. Last but not least, volatility index is still bouncing off this key support. I would like to see the VIX trading above 22. It just shows a lot more stock market fear and short selling within the stock market, and then we can correlate that to a further outflow in equities. But when you see the majority of stock market regions here, whether you're looking at North America, the UK 100, and of course the UK there, the German DAX and so forth, we're still very bearish, seeing less optimism in equities as global investors fear major central banks continuing to tighten financial conditions, possibly more rate hikes, and the more important thing is how long they're going to be keeping rates up, as global inflation in the Eurozone, Australia, UK, and North America still remains elevated and near high risk levels. Now, we went through some key fundamentals, we went through market sentiment analysis, some good reminders. Before we jump into the individual technical analysis across pairs now, we just want to look at what events we have in focus for the Asian session, London session, and New York tomorrow. And also keep in mind the start of the new business month. So a lot of the data that we already had take place in the previous London session and North American trading session held little weight and kept market sentiment relatively mixed, as we saw just consolidations and pullbacks today, and overall some end of month rebalance of flows. GJ doing a more aggressive pullback here, as you can see, but still maintaining overall intraday and higher time frame bullish structure. Gold having a little bit of pullback from these new lows printed. GBPUSD had a pullback. EURUSD. UCAD had a little bit of a bearish pullback. But overall, still maintaining the same market structure of dollar domination we're looking to extend, and GJ being more bullish. So we didn't have the data take away from any of that. Other than that, we don't really have much going on through the Asian session in terms of economic data coming up. But we do have some important economic data for anybody who's going to be trading London session, with focus on some UK housing prices and PMI data from the Euro side. At 2 a.m. Eastern, we have some house pricing data from the UK, which is expected to be a lot weaker. Now, this may just lead to some short-term GBP weakness against the yen and some pullbacks, but overall, the British pound is still relatively stronger against the yen, as the Bank of Japan keeps their monetary policy loose and a lot more on the dovish side, while the Bank of England still remains hawkish and just had Brexit deals completed, plus some price setups for this new business month, of course. So I don't think this data is going to hold too much weight. At 3:50 a.m. Eastern, 3:55, and 4 a.m. Eastern, we have PMI figures for Eurozone. France PMI, Germany PMI, Germany unemployment data, and Eurozone overall manufacturing PMI. I can still see this data being relatively neutral, still leading to some Euro weakness, and Euro USD still remaining bearish on the intraday timeframes, give or take some minor pullbacks. At 4:30 a.m. Eastern, we have some UK economic data. Adam Kins, you're a retard. You should go look at 1970s US inflation for reference points, but no, we're not even close to inflation being lower or done yet. You can hope for that though, and good luck with that. At 4:30 a.m. Eastern, we'd have some consumer credit mortgage lending approvals data for the UK, but the main important thing is your manufacturing sector PMI. If we can see that UK PMI is still relatively healthy, coming above the 50 grade point as well, we're easily going to be having some upside moves on GJ and continuing some of the bullish bias. Other than that, the important U.S. economic data is through the New York session, of course, after NYSE at 9:45 a.m. Eastern and 10 a.m. Eastern, with your manufacturing S&P Global PMI and ISM manufacturing PMI. I'm expecting this data to be relatively healthy and showing some slight rebounds. And if the data is showing some slight rebounds around the forecast and above the prior, this can still lead to some more demand in the dollar, less demand in the stock market as well as gold, as the markets can see the economy is robust enough to handle more rate hikes and tightening of financial conditions by the Fed, and that anticipation move starts to get priced in ahead of time, right? Now, when we're looking at gold here, overall, the reason why gold has had this aggressive bearish market structure formation here ever since we peaked around the 1950s is we started to have catalysts feeding into the dollar domination aspect of price. Just let me type it out here for everybody. Get this epic pen. So the main reason we saw this short-term upside rally on gold, relief rally on the stock market, and so forth was manipulated CPI reports from November and December. We were told at that time CPI was declining, which was taken as optimistic for the Feds to pivot and stop hiking rates. What actually ended up happening is before the last CPI report, the US Bureau of Labor Statistics came out with revisions that November and December CPI was actually elevated. The same time November and December CPI is elevated, US unemployment rate remained low and non-farm payrolls came out extremely optimistic, with core PCE data also showing elevated inflation from a consumer paid prices standpoint. So we had a bunch of catalysts from optimistic jobs data, revised CPI, higher active CPI, FOMC revisions through meeting minutes, stronger retail sales, higher PCE data, stronger PMI. All of these catalysts in collective have the markets pricing in the Federal Reserve tightening financial conditions further. This is why you have dollar strength, stock market bears, and gold bears. But you have to understand something that we always teach in market psychology. It's a lot easier for the stock market to be bullish rather than bearish. When the stock market is bearish, it has a lot of negative impact on corporate profits, business activity, and the most important, one percenter wealth, the ultra rich and wealthy, their overall investment portfolio and wealth value, right? On the other flip end of the coin here, when dollar is extremely bullish due to this same fundamental reason here, it also has a lot of negative impact on global emerging countries' debt obligations, other countries' currency values, and of course takes away a lot of demand on global investments into risk assets. So the market, the greedy stock market buyers, right? The greedy stock market buyers, as well as the one percenters involved in these corporate America and stock market regions in other parts of the world, they don't want the Federal Reserve and ECB to be tightening financial conditions. But the ECB, the Federal Reserve, the Bank of England, they have no choice to tighten financial conditions as inflation has risen to high risk levels through the pandemic printing period when interest rates were at zero or in the negative for the ECB, and you had all this money printing and being flooded into the market, leading to very high risk inflation. Inflation still remains elevated above 6% on the macro, and the fight on inflation can take years as long as these stock market prices remain elevated, asset class prices are elevated. We still don't have the tightening of financial conditions fully taking effect. And of course, unemployment rate is still very healthy and the job market still very healthy. So this fight on inflation, if you can reference other parts in history within the US, as history always repeats itself because human nature doesn't change, and the central banking policy and actions are no different than other financial crisis periods as well, the fight on inflation can extend for years. The market wants the Feds to pivot so they can go back to having favorable investing conditions of low interest rates and pumping more money into the stock market so they can get richer. But the Feds, the ECB, the Bank of England, have switched their role, mandate, and job to no longer be supporting the economy and markets, and instead to be combating inflation before it spirals out of control. The Feds themselves have referenced 1970s US situation, talked about it in FOMC meetings, and even revised the last FOMC meeting minutes. So I'm talking about the US here, and the Feds themselves have talked about not wanting to let US inflation unravel similar to the 1970s and taking more action on tightening financial conditions. You guys can go fight and have your predictions and do whatever you want, but I'm the one who does the webinars, puts my balls on the line, and has been right for the last 2 years with what's been going on in the markets and monetizing it. While some other people just want to talk in the chat, maybe you should go make a webinar of your own and let us watch it and send it to us, right? But that's the main reason we've started to see dollar domination come back into the scene from the start of 2023 here, with dollar bulls, gold bears, and the stock market being more bearish. Hence, we've been having that continued analysis from every weekly market update webinar, right? So now, when we're looking at gold on the intraday time frame, you can see we're just having a pullback from this 1800s key higher time frame liquidity zone. But it's very common whenever you look at market structure, when you get these consecutive lower lows printed, you have these pullback phases as sellers liquidate positions out of the market, buyers jump in hand to provide that exit relief, and you have this short-term pullback to set up prices from better price points of interest and continue to be driving price down. As we're just starting out the new month, even if gold was to come up to the 1840s here, we would still be very bearish, and especially if we just continue to hold below 1828 and 1830s. We still have more demand in the dollar, as well as the economic data having the markets price in further tightening of financial conditions by the Fed. You can fight that as much as you want. That's the reason why gold has been dropping from 1950 to 1800. It's the reason why dollar has bounced from that higher time frame zone of interest and is still trending bullish on the higher time frame. And it's also the same reason why the US stock market has seen this outflow from 34,500. I like to trade what I see and what is actively happening in the markets, plus my predictions based on real fundamentals, not just theories and what I hope to see happen based on my own subjective wants. I always like to be very objective and just stay adaptive to what's actually going on in the economy and markets. So, when we're looking at gold here, some things we just have to keep in mind are the PMI data. Now, for some short-term trades, as we're still just early into this new potential business month, if we break above 1836, I can easily see some pullback plays to retest better higher time frame sell zones of interest, meaning I would take short-term buys above 1836 as we can retest those higher time frame zones around 1845 and in the 1850s and still be very bearish on the higher time frame. Otherwise, if we double top in this area and remain below 28 and start coming back below 1820, just continue your higher time frame and intraday sells on gold. The main fundamental factors are the collection of economic data feeding into the dollar domination narrative, hawkish revisions in the last FOMC represented in the meeting minutes, more hawkish comments from Fed speakers themselves, elevated inflation figures seen from the data revisions of November and December, and even the last higher CPI report, and of course the higher PCE data. If we have optimistic PMI data tomorrow, give or take this pullback, we will be continuing more bearish down to these lows. I only see some gold buys and short-term buys above 36, which would still be leading to better higher time frame sell zones in my opinion. Keep in mind the start of the new business month where we could see those pullbacks to set up better order flow from better price points of interest before continuing the higher time frame trend. Also, when you're looking at gold, that upside rally that we saw take place conveniently came to this same sell side liquidity zone, just a retest of broken structure, and this monthly candle has almost engulfed the previous monthly, where the next month, if we just get a minor pullback and we still have continued elevated inflation figures, we still have stronger US economic jobs data, we still have hawkish Fed speakers and more demand in the dollar, we're easily going to be making our way back down to the 1750s and 1700s. Now, on our dollar pairs, this is a similar idea. You can see on the higher time frame, GBPUSD and the other dollar pairs such as EURUSD are still very bearish. All we had take place for the start of this new year, from impulsive historical lows that have been printed, was a delusional rally that was based on declining CPI, which was actually false now that we found out with the revisions. What we thought was declining CPI at the end of 2022 from November and December was actually incorrect. Monthly CPI was still elevated and increasing, and overall inflation still remains elevated as long as the labor market is this robust. All these asset classes from commodities and stock market are still at these highs, and of course, dollar still remains above that key demand zone from that price point of interest, with the inverse of GU just retesting these historical lows and still maintaining this bearish market structure on the higher time frame. When you're looking at the overall sell side downward move we had on GU on the higher time frame, this is just a 50% correction. Really, that was setting up better price points for sellers into 2023 here. More of the inverse of how dollar retested that key historical monthly demand zone that we already discussed at the start of this webinar. Right? So when we're looking at GBPUSD, as long as we're still especially remaining below 1.22, we're very bearish on the higher time frames. And on the intraday time frames, we're really just creating this short-term consolidation area. We had very nice rejections at this previous liquidity zone, where even if we retest 1.21, remain below 204, and break below 1.198 key level, as long as dollar still remains bullish, we don't break above these rejection points in sell side liquidity zone, we're still going to be looking for GBP USD sells and continuing to extend dollar domination. Euro USD, exact similar idea, except Euro USD has even stronger bearish market structure. Sellers consecutively printing these lower lows, just having these short-term pullback phases, which sets up prices for sellers at better price points, also traps a lot of retard buyers in the market who think dollar domination is over and inflation is dropping, and still maintaining bearish market structure, potential to be revisiting these lows again. A double top at 1.0654, hold below this gray zone and break below 1.052, I would still be looking for Euro USD sells. Right? We still have the markets pricing in more tightening of financial conditions by the Federal Reserve due to elevated inflation, robust labor market data, and hawkish revisions in the FOMC meeting minutes. We still have very nice bearish structure. This pullback that we're seeing is still from new intraday lows being printed. Very nice rejection around previous lows in key level 1.0654. We could easily get double tops and retests of south side areas multiple times and still be maintaining bearish market structure and the same intraday and higher time frame bias. Now, keep in mind, the information I'm telling you is not being validated by my guesses or by me just saying some random shit. The market's pricing in the tightening of financial conditions by the Fed, it's being shown in multiple asset classes. You can see it on an individual precious metal like gold, and that's the reason gold's been bearish from 1950 to 1803. You can see it on currency pairs with the dollar as a secondary. That's the reason why GU's been bearish from these highs, Euro USD in bearish structure. You can see it on currency pairs that are the inverse with the dollar in the primary, beautiful bullish structure. And you can see it even on stock market indexes with US 30. Very strong bearish structure, buyers starting to take profit, more sellers in control there, still respecting the price anatomy of a bear market in equities, right? So it's not me telling you this, it's the market. If you want to fight the market, go ahead. You're going to get knocked out. You're going to lose your account. You're going to crash your account. You know what I mean? No, the goal of the Fed is 2% inflation. That's literally their goal. They've said a million times publicly themselves in FOMCs. And the whole point of them raising rates is inflation. Their goal is not, the Federal Reserve's goal is not a strong economy. Otherwise, they wouldn't be raising interest rates and tightening financial conditions. That doesn't strengthen the economy. And you said, watch when inflation comes to 4%. Inflation isn't at 4%. Inflation's at 6+%. Nobody listen to this Adam guy, full retard. Let him keep trying to sell the dollar. You can go read any FOMC meeting minutes. Their whole goal is to bring inflation down. Here, let me show you guys. Here, let me show you guys. We'll go back to... I'm just going to go random months here, right? Okay, here, this is from some other Fed member as well. Okay, let me find Powell. You're wrong. You're dead wrong. This is Jay Powell. This is your fucking hero you're talking about. This is Jerome Powell, February 7th this year, saying it will take into next year to get close to 2%. Next year, this year is 2023. 2023. This is the second month of 2023, third month now, right? Powell, your boy, right? Jerome Powell of the Federal Reserve said it will take into next year to get back to close to 2%. So, I don't know what you're fighting. Nobody trusts you. You're not Jerome Powell. You're not the Fed. No, he doesn't have to say that. They can say whatever they want. They're the Federal Reserve. You're delusional. First you said their goal is strong economy. Where? All of the Fed's goal is to bring down inflation. The goal is to bring inflation to... This is Jerome Powell, February 7th. This is February 7th from Jerome Powell. Not from me. Not from me. Stable prices is inflation data, dumbass. Powell. This is Powell. This doesn't say Jeeve. This doesn't say Jeeve here. You know, it doesn't say Jeeve. It's not me. That's Powell, right? It will take into next year to get back to 2%. This is Federal Reserve Williams. 2% inflation is our foundational target. This is Powell. We have the tools to achieve the 2% target over time. This is Fed's Jefferson. Important to get back to 2% inflation. So you guys can listen to whoever you want. I'm going to listen to the central bank. That's the reason why gold has been bearish, dollar's been bullish, stock market has been bearish as well. 2% inflation is a global central bank goal, dumbass. Even the Bank of Japan has a 2% inflation goal. You want to bet? This is Bank of Japan's governor nominee Ueda. Central banks have set inflation target. Central banks, plural, have set inflation target at 2% to leave themselves room for future rate hikes, a practice Japan has already applied. 2% is a global central bank goal. The Bank of Canada, the Bank of England, the ECB, the Bank of Japan, and the Federal Reserve. Like, you're wrong. You're wrong. So now let's go back to now that we prove that this guy is wrong and delusional, he can keep trying to sell the dollar. We're going to continue to play the trade idea stated. So a quick review here, because this guy's just getting annoying now. He's not giving any actual facts, just spamming in the chat. Like, go make your own channel and do a live stream. We'll watch your evidence then. And also, show us the trades you've taken. Let's see the trades you've taken. All right? Otherwise, shut the fuck up and get off my dick. You're my fan. You watch all of my streams. You're coming there, right? Now, quick review. Gold, we're still looking for sells below these areas. At the red boxes, only short-term buys. If we have a new monthly pullback in price setup above 1836, still leading to better sells at 52 and 45. GBPUSD is still bearish with double top sells at 2.1, holds below 204, and sells below 1.1985. Still looking to play dollar domination. The market's pricing in actively the tightening of financial conditions, bearish structure, and bearish price action. Euro USD is still bearish in market structure as dollar domination holds a lot more weight on a global scale because it's your world reserve currency and business currency. Even if we pull back to 1.0654 again, hold below gray zone 1.05, break these lows, still looking for Euro USD sells. USDCAD is the inverse because dollar's the primary in the quote. Oil's more bearish, keeping the Canadian dollar bearish. And of course, we have dollar domination with the markets pricing in more tightening of financial conditions by the Fed because inflation is still elevated and we still have robust labor market data as well. UCAD retests of 355, breaks out above 365, breaks above 368, would still be looking to play dollar bullish bias, expectations of stronger data to come, bullish market structure, and bullish price action. If you want even more information on this, you can obviously rewatch this webinar and watch the last 2 or 3 market updates where every single week for the last month minimum, my analysis has been on point. CPI predictions, data predictions, FOMC meeting minute revision predictions, Bank of Japan predictions. It's been all on point. So if you want more information, go and reference that as well. US 30, you can see we're still looking to have the bear market respected. This delusional relief rally in stock markets was due to false data that everybody thought CPI was declining, but then we came out with revisions in the previous weeks that November and December CPI was actually higher than expected. This is why we're still rejecting this key sell side liquidity zone and potentially having a break of this structure in range and maintaining bearish price action and bearish structure as well. Give or take some pullbacks, as long as there's more demand in the dollar, we still have optimistic US data feeding into the dollar domination narrative. If VIX turns more bullish to 22 as well, give or take a pullback, US 30 is still bearish. When you're looking at market structure, when we had sellers print these lows in this relief rally, we had buyers liquidate positions from 34K roughly flat and lead into lower lows. This more aggressive pullback phase was really just to keep markets and economies optimistic, consumer morale up into the end of 2022 and into the end of the holidays there. But now you can see the reality is setting into place where we're failing to break above there any further, retesting that same sell side liquidity zone and actually having revisions that CPI is still high, economic data is robust enough for the markets and economy to handle more rate hikes and more hawkish Fed speakers. Give or take some pullbacks, we should be chugging back down to 31K, 31.5. On the intraday time frames here, we're also respecting very nice bearish market structure. Even if we get pullbacks to 33K flat, I would be looking in these 3 areas for still continued US 30 sells. Overall, we have bearish market structure, bearish price action, bearish fundamentals. No reason to be buying US 30 unless VIX is breaking that support level and US 30 is breaking well back above this liquidity zone at 33.3. Okay? Last but not least is GJ. GJ has been more bullish on the Brexit deal being completed and a dovish Bank of Japan being the more important focus. On the intraday time frames, we've respected very key demand zones at 156, had a breakout of range highs at 161, forming much stronger bullish market structure as well, still having buyers print these higher highs in this trend, and just having these short-term pullback phases. This pullback phase made a lot of sense as well, as it's the end of the business month and setting up order flow for the new month. Overall, the majority of these pullback phases just go to retest better price points of interest, usually previous highs, before still continuing the overall trend. As long as the Bank of Japan keeps their monetary policy loose and inflation remains elevated in the UK, having the Bank of England put more pressure on tightening of financial conditions, we're still going to be moving up in this formation. The areas of interest I would be looking for GJ buys, the first area of interest is looking for double bottom holds of previous highs around 163.5. If we can get a support created here in double bottom, we can easily see the same sequence of events that have occurred after every single time a high has been printed. You have a short-term pullback phase. Here we can see it here. Here you have the pullback phase here. But as soon as you start to stabilize price at a key demand zone or potentially even previous high areas here, you can see you have those very nice rallies as the fundamentals still remain bullish to be trending back to the highs and even higher. So I'm going to be looking at 163.5 or 162.5 deeper pullback buys on GJ. That marked out into some trade ideas here would be buys here or buys here. If we break below the previous high and you want to take some of those short-term scalp sells, that'd be your own potential trade idea to counter trend trade. But I rather stick to overall macro bearish yen, dovish Bank of Japan keeping interest rates in the negative and monetary policy loose, intraday and higher time frame bullish structure on GJ, Brexit deal being completed, historical repetition of the post-2008 run, and still maintaining the integrity of bullish market structure of just having buyers print highs, aggressive pullback phases, and continuing trend. Okay? So pretty much that's it for today, everybody. Keep in mind these key fundamental points. Dollar domination is still active on the markets, pricing in tightening of financial conditions by the Fed ever since we've had elevated inflation revisions, FOMC meeting minutes revised, hawkish Fed speakers, higher CPI, higher PCE data. Japanese yen is still bearish on the higher time frame with dovish comments from the Bank of Japan new governor nominee. Brexit deal's been completed. We're just having the end of month rebalance of flows, and keep in mind the start of the new business month price setups. Market sentiment still remains with dollar bullish bias, bearish bias on the Japanese yen, bearish bias on majority of equity market regions. Keep in mind the economic data we have highlighted for tomorrow that we talked about over the European session and of course with US tomorrow. Also, keep in mind some of the Bank of England speakers. Bank of England Governor Bailey is going to be talking about inflation in the morning. And we also have Federal Reserve Neil Kashkari at 9 a.m. Eastern. Both of these Fed speakers and Bank of England speakers should still be hawkish in my opinion. You can always re-watch this as you wish. I highly advise you watch the last 2 or 3 weeks of market updates, as this is just continuations, and you're going to see how analysis and trade ideas have been playing out for months, right? I also highly advise to check out all of your Capital Hungry educational webinars to learn about central banking, so you don't end up like that Adam retard in the chat thinking like the feds are trying to focus on a strong economy or some shit like that. Stupid, I don't know what the fuck he was saying, some retard shit, right? So learn as much as you can about central banking. Tons of webinars on that. Check out the free news Twitter, Telegram analysis channel, and I'll see you guys next time.